Today, we're doing a complete breakdown of ASC 320. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a world where companies freely shuffled investments between categories to manipulate earnings. Before ASC 320, this was a reality. Now, consistent classification rules ensure transparency. After this section, you'll understand how ASC 320's approach clarifies financial reporting by categorizing investments precisely, impacting earnings and risk assessments. ASC 320 emerged to end the chaos of inconsistent investment reporting. Before this standard, companies could manipulate earnings by shifting investments between categories. This lack of transparency led to unreliable financial statements. With ASC 320, every investment has a clear category, ensuring comparability and transparency. Now, investors can make informed decisions, understanding a company's true financial position and risks. This standard is pivotal for maintaining integrity in financial reporting. ASC 320 is crucial for any entity holding debt or equity investments. Effective from the early 90s, it revolutionized how investments are reported. The core requirement is categorizing investments into held to maturity, trading, or available for sale. This classification directly affects how gains and losses are recognized, impacting reported earnings. It's not just about compliance, it's about presenting an accurate financial picture. Understanding this requirement is vital for financial transparency and investor trust. The investment classification model is a cornerstone of ASC 320. Transforming how investments are viewed. By classifying into held to maturity, trading, and available for sale, it dictates how gains and losses are recognized. Trading securities influence net income directly, while available for sale affects equity. Understanding this model is critical for interviews. It shows you grasp the nuances of financial reporting and the significant impact on a company's financial statements. It's not just classification. It's strategic financial insight. Understanding the scope of ASC 320 is crucial. A common mistake is assuming real estate investments are included, but they're not, and that's a classic interview trap. Scope dictates which financial instruments are subject to this accounting guidance, influencing how they're reported and valued. ASC 320 covers specific types of financial instruments. Debt securities like corporate bonds fall here, demanding fair value assessment. Equity securities, unless consolidated, are included, impacting their valuation. Investments in subsidiaries and joint ventures are scoped if not consolidated, affecting their balance sheet representation. ASC 320 explicitly excludes certain financial instruments. Real estate investments fall under ASC 360, not this standard. Derivatives are accounted for in ASC 815. Government securities needing different treatment belong to ASC 940. Securities under ASC 860 for transfers are also outside this scope, a crucial distinction in practice. A debt security is a financial instrument representing a loan, typically seen in corporate bonds. Investors lend money with the expectation of interest repayment. Corporate bonds illustrate this, varying in maturity. Assessing credit risk is essential, influencing how these are valued on financial statements, impacting profitability. An equity security represents ownership, like common stock, granting shareholders rights in voting and dividends. These are crucial in balance sheets, affecting the equity section. Common stock's valuation varies, leading to unrealized gains or losses impacting profit and loss. Ownership interest drives business influence, shaping financial strategy. Navigating edge cases can be tricky. Municipal bonds fall under government securities, not ASC 320. Foreign equity investments are included unless consolidating. Joint ventures needing the equity method are ASC 323 territory. Mortgage-backed securities are handled by ASC 860, not this standard. Knowing these distinctions prevents costly errors. Imagine a company with a diverse investment portfolio, struggling to accurately report its financial position. ASC 320's classification model resolves this by standardizing how investments are categorized and measured. companies like Meridian Corporation can now confidently report investment activities with precision, enhancing trust and clarity in financial statements. This model guides businesses through classifying investments, ensuring financial reports reflect true economic positions. We'll track Meridian Corporation's $10 million SaaS contract with Acme Incorporated through each step. Understanding whether investments are debt or equity, their holding intent, and proper measurement is crucial for transparent reporting and informed decision-making. Meridian Corporation's contract with Acme Incorporated begins by determining if investments are debt or equity. This step sets the foundation for accurate classification. Misidentifying these can lead to incorrect reporting. For Meridian, the focus is on any financial elements linked to the $10 million contract. Clear identification guides subsequent steps in the ASC 320 model. Following identification, Meridian Corporation must decide if their investment is held for trading, available for sale, or maturity. This decision impacts how the investment is reported. Misjudging intent can skew financials. For Meridian, clarifying their holding purpose directly affects future measurement and reporting. Step 2 culminates in a clear holding intent, vital for accurate security classification. Meridian Corporation uses the holding intent from Step 2 to classify their investment. This classification dictates financial reporting and measurement methods. Errors here often stem from mismatching classification criteria. For Meridian, ensuring that their investment aligns with trading or available for sale criteria is crucial. Correct classification streamlines reporting and sets the stage for accurate measurement. Measurement hinges on classification. Meridian Corporation, having classified their investment as available for sale, measures it at fair value. Misaligning measurement with classification leads to valuation errors. For Meridian, aligning with ASC requirements ensures the investment reflects its true market value, impacting reported earnings and asset valuation. This step's precision is crucial for accurate financial representation. Meridian Corporation concludes by recognizing gains or losses. For an available for sale security, these are recorded in comprehensive income. Missteps in this phase, like misrecording gains, distort financial statements. For Meridian, adhering to ASC guidelines ensures that the investment's financial impact is transparent and accurately reported. This final step solidifies the investment's financial portrayal, concluding the classification journey. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Understanding ASC 320's measurement options and mandatory disclosures ensures accurate representation of financial health. Whether fair value or amortized cost, each choice demands specific reporting that can affect investor perception and compliance. Initial recognition under ASC 320 demands precision. Debt securities hit the books at fair value on trade date. Equity securities follow suit unless exceptions pop up. Don't forget, transaction costs? Expense them right away for fair value cases. For amortized cost, ensure you have the intent and ability to hold those securities to maturity. It's all about timing and intent, shaping your balance sheet from the start. Subsequent measurement in ASC 320 adjusts based on classification. Held to maturity? Stick with amortized cost unless impairments surface. Available for sale? Fair value fluctuations hit OCI, keeping net income steady. Trading securities? Fair value changes flow through net income, impacting earnings directly. Consistent impairment checks ensure assets reflect reality, safeguarding against overstated values. It's a dynamic balance between stability and transparency. ASC 320 defines clear paths for presentation. Held-to-maturity securities nestle under investments at amortized cost, presenting stability. Available-for-sale assets? They also slot under investments, but with fair value tweaks noted in OCI. Trading securities shake things up, affecting both investments and net income with fair value shifts. Disclosure notes must unravel these layers for clarity and compliance, illuminating classification and value dynamics. Disclosures under ASC 320 are not just formalities. Fair value transparency for available for sale and trading securities informs stakeholders. Unrealized gains or losses in OCI need clarity for available for sale assets. Even held-to-maturity securities, stable as they seem, must reveal fair value for full disclosure. Impairment losses and recovery narratives add depth, ensuring investors get the complete risk and recovery picture. It's about painting a full financial portrait. Picture this. A CFO manages $10 million in bonds, opting for fair value to mirror market realities. This choice shifts $500,000 in unrealized gains to OCI, aligning the books with current market conditions. An annual impairment review flags a $200,000 loss, prompting asset value adjustments. Clear disclosures reassure investors, preserving trust and adherence to ASC 320. It's a strategic dance between accuracy and transparency, vital for financial integrity. Meridian Corporation, a global manufacturing company, invests $1,200,000 in a diverse portfolio of debt securities. Watch how each accounting event unfolds as the company navigates the complexities of ASC 320, ensuring accurate recognition and reporting. Meridian Corporation makes an initial investment in debt securities classified under ASC 320. This classification determines how these securities are measured and reported. The journal entry reflects the use of cash to acquire these assets, impacting the company's liquidity while adding to its financial assets. This is crucial as it sets the stage for future accounting treatment, ensuring the securities are recorded at fair value. ASC 320 requires debt securities to be recorded at fair value. Meridian Corporation's portfolio increased in value by $50,000, necessitating an adjustment. This gain is recognized in other comprehensive income, reflecting changes in market conditions. Maintaining accurate fair value is essential for transparency and aligns with ASC 320's objective of providing users with relevant financial information. Interest income from debt securities is recognized when earned. Meridian Corporation received $30,000, enhancing liquidity and reflecting in the income statement as revenue. ASC 320 mandates timely recognition of interest to portray the economic benefits derived from financial assets. This consistency in capturing income helps in evaluating the company's performance and cash-generating ability. Under ASC 320, impairment in debt securities must be recognized when indicators of credit loss appear. Meridian Corporation securities suffered a $20,000 decline due to market conditions. This impairment loss directly affects the income statement, reducing net income. Recognizing impairments ensures that financial statements present a realistic picture of asset valuations and potential recovery risks. Selling securities involves recognizing proceeds and calculating gains or losses. Meridian Corporation sold securities for $1,150,000, realizing a $50,000 gain over the book value. ASC 320 mandates the recognition of realized gains in net income, which reflects in Meridian's profitability. This transaction underscores the balance between investment decisions and their impact on financial performance. ASC 320 requires reclassification of unrealized gains from OCI to realized gains in the income statement after a sale. Meridian Corporation transferred $50,000 from OCI, aligning financial statements with realized outcomes. This ensures comprehensive income reflects accurate investment performance, demonstrating the importance of clear reclassification for transparency and comparability in financial reporting. At year-end, Meridian Corporation adjusted remaining securities to reflect current fair value, recognizing a $10,000 decrease in OCI. ASC 320 requires this to provide an accurate financial position. Continuous fair value adjustments show how market fluctuations affect asset values, emphasizing the importance of reflective financial statements that aid stakeholders in making informed decisions. Derecognition occurs as Meridian Corporation sells off remaining securities, marking the end of its ASC 320 journey. This involves removing both the asset and corresponding cash inflow from the balance sheet. The process highlights how investments transition through the accounting lifecycle, emphasizing the need for precise tracking and reporting to maintain financial integrity and reflect true economic outcomes. Every Big Four and investment bank interview on ASC 320 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 320 addresses the accounting for investments in debt and equity securities. Its purpose is to ensure that financial statements reflect the current value and performance of these investments. The common mistake is confusing the categorization between trading, available for sale, and held to maturity. Remember, ASC 320 impacts how gains and losses are reported on financial statements. ASC 320 exists to standardize how investments in debt and equity securities are reported, to enhance comparability and transparency in financial statements. The logic is to reflect true economic performance and risks. A key takeaway is the importance of classifying securities accurately to prevent misleading financial statements. Changes in the fair value of available for sale securities are recorded in OCI, not directly in net income. The logic is to preserve income statement stability while reporting unrealized gains and losses. Avoid the trap of confusing this with trading securities. Memorize: unrealized gains/losses go to equity, not the income statement. At maturity, the company removes the security's carrying value, recognizes any final interest, and the cash receipt is recorded. The principle here is matching principle, recognizing interest over the life of the security. Avoid neglecting to record the final interest. Key point: the book value should match cash received. ASC 320 classifies securities into three categories, while Indian Accounting Standard 109 uses a business model approach with fair value through profit and loss, or OCI. A major difference is in impairment methods. Don't overlook how these affect reported earnings. Key takeaway: understand classification impacts on financial metrics. Trading securities fair value changes hit net income directly, while available for sale changes go to OCI. The reason is different management intents: trading for short-term profit versus available for sale as investments. Don't mix these up on financial statements. Crucial: recognize where unrealized gains, losses impact financials. Calculate the difference between cost and current fair value. Then assess if it's other than temporary. If so, recognize the loss in net income. The key is judgment on permanence. A typical pitfall is misjudging temporary declines. Memorize: only other than temporary losses impact net income directly. Record dividends as dividend income when declared, increasing cash or receivables. This reflects earned income. Avoid the mistake of confusing dividend income with a security's fair value changes. Key point: dividends impact income statement today, unlike unrealized gains or losses on equity securities. Derivatives are excluded from ASC 320. They're covered by ASC 815 due to unique risks and accounting requirements. A common trap is assuming all financial instruments fall under ASC 320. Key takeaway: know the specific scope of ASC 320 to avoid misclassification. A CFO must disclose fair value, amortized cost, and gross unrealized gains losses for securities. Also include the rationale for classifying securities and any impairment losses recognized. The trap is omitting detailed breakdowns. Key point: clear disclosure ensures stakeholders understand financial impacts fully. ASC 320 zeroes in on how to account for investments in debt and equity securities. Trading securities are for quick resale. Available for sale securities are in between trading and held to maturity. Held to maturity securities are debt held until they mature. Equity securities reflect ownership, while debt securities indicate a creditor relationship. Understanding these categories helps in applying the standard accurately. Under this standard, investments fall into three categories: trading, available for sale, and held to maturity. Trading securities are fair valued through earnings, while available for sale are through OCI. Held to maturity stay at amortized cost. Fair value represents market price on measurement date, and amortized cost tracks initial amounts less repayments. OCI captures unrealized changes for available for sale securities. Misclassification under ASC 320 can skew earnings and balance sheets. Unlike international financial reporting standards, ASC 320 allows reclassification but demands strict conditions. Disclosures must include fair value and realized gains. Reclassifications need justification due to their financial impact. Trading securities affect net income immediately through fair value changes. Failure to demonstrate intent for held to maturity can be problematic. OCI plays a pivotal role, affecting equity without altering net income. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.